Howdy, Jacob here. Today we're looking at Cantaloupe, company in the software industry, not the fruit. 42 million in revenue in 2014 to 244 million in 2023. So we're looking at humongous growth here, averaging mid-single digit revenue growth year every year. Gross margin in the 30% range, operating margin still trying to find it. They're likely still trying to invest back in themselves to grow a substantial amount. And return on invested capital kind of a wash again because they don't make any net income, and their R&D spend is roughly 10% of revenue. It went down a little bit the most in the rolling 12, but you're looking at definitely 5 to 10%, and their net income's relatively flat, so we could bump that up to probably 5 or 10, just being realistic of where we think their margins can go. They have 51 million cash on hand, 1 million short-term debt, 38 million long-term debt. They have enough cash on hand to write off all of their interest-bearing debt, including that 3 million of capital leases. Cash flow is actually a similar story. I thought that maybe it could be different, where they produce some good cash flow and not necessarily net income, because depreciation, amortization, and stock-based compensation overthrew capital expenditures. But we're actually not seeing that. And weirdly enough, their capital expenditures are kind of all over the place. So a consistent company is going to have a consistent amount of money they need to reinvest for their business to stay afloat. Here, they got as high as 16 million, as low as, I guess this could include, well, they have a line for acquisitions as well. So that's kind of interesting. I don't know what these sell-offs of capital expenditures could be. And they issue a bit of shares. I mean, it's just a young, growing company. So that's not my forte for projection-based purposes. I like companies that have been around for quite some time that I know are going to be at least within a very reasonable range. Here, I don't have that range, so I'm creating a story. I'm going to need extra margin. So growth rate, I think, probably be, I mean, they're still really small. What's their insider ownership? Insider ownership is just under 10%. Not terrible. I think maybe 12% a year. Let's do a pretty large range because I'm not sure exactly where it's going to end up. Stock-based compensation is really about 1% of their shares outstanding. Terminal PE, probably 20, but I'll need a 17.5 return because I'm creating more of a story here. They haven't produced these free cash flow figures yet, and so, or these margins yet. So I'm just asking for a bigger return here, and it still needs to fall 6% before I get the return I'm looking for here. So I'm not going to be, it doesn't look obviously cheap, even as the novice company they are, for me to really want to do more research into them. But I hope you enjoy the video and have a great rest of your day. Thank you.